Good afternoon, everybody, and welcome to today's Stock Market Brief Show. We got a lot to discuss on today's episode because holy moly, on the last one, right, we were talking about how things are getting a little tipsy on one side of the boat, and it felt like I got to kind of stabilize myself by moving towards the middle because things tend to get shaken up. Well, we definitely saw the repercussions of seeing the market get shooken up a little bit. So I want to really focus in on key levels, not only in the index products, which we'll get into the SPY, the Q, the IWM, but I want to look at the sectors, and I also want to look at the larger market cap names, where they are in relation to their weekly expected moves. And I'm going to just discuss kind of how I'm going about approaching this right now in times of elevated volatility. Now, if we look at the 11 sectors today, how did they fare? Energy led the way. We had utilities up there. We had healthcare, consumer staples. So it was a much more of a risk-off type of trading environment. If you look at the index products, how did they fare? Well, the S&P 500 was down 76 basis points. The Dow Jones, 28. And the NASDAQ was down 1.2%. So it looks pretty rough if you're just looking at the screen like this, but if you're trading intraday, we made some pretty significant rebounds on various news. So let's go ahead and hop into some of these various charts. The first one I want to talk about is where we stand in relation to the Gamma flip line. So first and foremost, we started right down here this morning, and we started really kind of just banging around over here until we kind of elevated and found our way back up to and around that Gamma flip line. We are still underneath it. So at this current point, I'll call a spade here. We are in negative Gamma territory, but since we're right by the flip line, I'm going to call this rather neutral behavior. So we're kind of in that zone where there's a lot of confusion, and you can really see that in the overall price action. So going into tomorrow's trading session, a critical level is going to continue to be around this 6,000. Below that is going to be 5,900. And then up to the upside, we're going to be looking back at 6,100, which we've came in there a few times and we keep on getting rejected or some sort of news hits the tape. And you see kind of an explosive move back to the downside. So first and foremost, we're in negative Gamma territory. So out of the gate, when we're in negative Gamma territory, this does change the way that I typically approach swing trading. When I swing trade, I look for speculative breakouts or breakout trading. And when you're in a negative Gamma regime where dealers sell into selling, they buy into buying, you typically get a lot more fake outs and shakeouts and whipsaws on the various the trades. So what I tend to see that works better is more mean reverting trades. And mean reverting trades means you take advantage of stronger volatility and potentially trade it back into kind of a range, back into like the median portion of a range and so forth. So I'll walk you through how I did that with S&P 500. But before we get into that, I want to look at all the various sectors right now, indices, and where they stand in relation to their 5-day moving average. And you can see here, SPY is currently trading underneath its 5 DMA. And right now, it may be trading more north towards that because we did get some news as soon as the bell closed as well and caused a little bit of a rip there. Q is also currently trading around its 5-day moving average, which is the purple line, and then you are right about that year-to-date anchored volume weighted average price. Semiconductors, you can't really see there, but we are starting to flatten out there. We have a DIA, which is starting to curl below its 5-day moving average, and XBI as well. I'll go ahead and actually put semiconductors right there in the middle of the screen so you can kind of get a good glimpse of it. So semiconductors, we saw that bounce back to the year-to-date anchored volume weighted average price, but we've since been slightly rejected, and it's yellow, which means just be cautionary over here because the 5-day moving average, it is trending up, but we're currently below it, so it's diverging from that. So if we stay here longer, it's going to start to curl over and turn red, but also we have the potential to snap back and reverse that current trend. So if we look at the SPY on the 15-minute time frame, our weekly implied move was rather large this week. It was above $10. The prior week was $8, and that was actually a big week with macro events, with earnings. And this week is also a big week, but the expected move is so much substantially higher. And if you take a look here, this is what I mean by somewhat mean reverting trades. We came back into the lower implied move pretty much right out of the gate this morning in the first 30 to 45 minutes of trading, and we actually got outside of the weekly implied move. So in this case, so what did I do? So I'll walk you through kind of my thought process and how I went to trade this. First and foremost, not last video, but the video prior, both of those days of trading, were days that I was kind of putting a little bit more caution out there. And the reason for that is because there was various signals and sentiment indicators and even breadth indicators that was telling me that things were getting a little bit too frothy. And after a month of seeing just a monster run up in performance, I felt it was necessary to start reducing the size of those positions into more pilot positions and potentially even less. Well, today, out of the gate, a lot of those remaining positions that profits were taken from, they got stopped out. But just because you get stopped out, you need to still be open and not overreact. If for example, if you had full positions and you're here and you got out and you were too afraid to get back in because you didn't understand these levels, you're going to be left in the dust in various occasions. So as we got down into this lower implied move, you go into something like a tool like market net flow. It gives you a good idea as to where the flow of the market is, whether it's bullish or bearish. And early in the trading session, it was the green line was above the red line, so that's already bullish. They weren't above zero, but you can see the SPY is the white line down here, and we still saw that bullish divergence there at the time. So in these situations, I look to start to trade to the upside for a mean reverting trade, because if market net flow is very bearish, I'd probably just step aside and I'd start looking for the lower levels of interest. And the lower level would be last year's closing price, right? 586.01. And I'll explain why that's such a critical level by showing you an example of how Qs and IWM are trading around it. So you take a shot and you see a little bit of a move to the upside. You can scale out some profits. You can leave it on to see if it recovers. But overall, right, when you do get a nice move like this, you want to potentially look to update your risk parameters, because you are still below a 5-day moving average. And on top of that, we are still currently in negative gamma. Now, if I turn on the overnight session, you can see that we came down, but we're now above where we were. So we'll see kind of what this looks like going into tomorrow's trading session. We could be right back down here. We can be up even further. It's anybody's game right now when you have news tape or news bombs that hit the tape felt like every 5 minutes today, which this was one of those events right here. Now, more specifically, I want to be clear. I didn't enter in underneath here. I actually waited for strength to confirm, and it came so fast, and I got right above this candle. That was for the entrance there for SPY. Okay, so the reason why that last year's closing price is so important is if I go to Qs, this little gray line was last year's closing price. If I zoom out a little bit over here, just take a look how critical it's been since the start of the year. So the start of the year was here. We broke down from it, we gapped above, and it acted as support. It then acted as resistance when we broke, and boom, we came into it, it held. Came into it, it held. And today we came into that level, and it also held. So that's why I would say last year's closing price is quite important. Even IWM did the same thing today, came into last year's closing price, and we started moving from that level, which tells me that if we start getting below that, if the market were to go negative on the year, I'd say just put pause on a lot of your trades, be cautious, and wait for things and conditions to get a little bit better. Now, if I go back into the SPY for the daily expected move going into tomorrow, we have about 603.50 and some change to the upside and 592 to the downside. I want to reiterate this like I did last week, and it came out to be true. That's what happened. But once you hit the lower weekly implied move, you can definitely see bounces from it or can undercut, but you tend to doodle in and around that for the remainder of the week. So as long as we can potentially get some decent news to potentially drive us further, to create some sort of catalyst to bring us up, just be aware that if nothing really comes and we start breaking below the week-to-date anchored volume weighted average price, it opens the door right back down to that lower implied move for the week. If we take a look at the Qs, the weekly implied move down here is at 509.47. We came close to it, but we didn't quite tag it. Daily implied move for tomorrow's trading session, put them on your screen, 511.70 and 524.52 to the upside there. Okay, and then for the upper weekly was 535. Okay, so if I want to take a look at some of the larger mega cap names, I want to bring you up and show you kind of where they're trading at. So Apple, right, after earnings, saw a nice move and it reverted, right, and we had follow through today to where? Take a look. It's lower weekly implied move. So right now, as it stands, Apple, we'll see what it looks like in the aftermarket. So it's trading currently back above it. But right now, Apple has already reached its implied move, which was roughly about $7.72 plus and or minus. So that's currently below the weekly 5 SMA. Sorry, the 5 period daily moving average. So if we start cutting through this and going further and market net flow looks bullish, you can potentially create opportunities back up into these ranges, but just be aware that Apple has already exceeded. So right when I see this, my first thought is you better not be shorting into the hole right here, but you can very well structure various different types of trades in and around these lower levels if you how to. If you take a look at Microsoft does not tag the lower implied move or the upper, but it is still below a declining 5-day moving average after already seeing quite a bit of a move to the downside here. I've just been seeing a lot of volatility there on the daily time frame. So this is the 15-minute time frame. You see we gap down and we closed basically just in a very tight range over here. The aftermarket session, it's kind of down. It's up slightly, ever so slightly. So there's Microsoft and its critical levels that you want to keep an eye on for the week. If we start getting follow through, we may very well get pinned in around these levels. But if we can break back above and we have some positive news and the market starts ripping and you're long Microsoft, watch for that 426.81, which is kind of right now in confluence with the declining 5-day moving average. Now, Google also will be reporting here somewhat soon, right? We have Google tomorrow after the bell, and we have quite the expected move in Google. But instead of going through that right now, because it will change, I want to just call out what its weekly implied move was. And it's probably have a very strong possibility of tagging and or exceeding one of these implied moves. So we're currently above that rising 5-day moving average. That's positive. When you look at the daily time frame, it's also been looking really good. We've just been in this consolidation pattern, holding the quarter-to-date anchored volume weighted average price, the year-to-date, etc. So we kind of just pulled back a little bit here as we're approaching earnings tomorrow. And if we do, right, if the market likes what it sees, there's a very strong possibility that the very next day we see this thing trading up and around 218 as a possibility. If the market doesn't like it, well, we can be breaking that 190 level or coming down to test it out. Let's take a look at Amazon. Amazon is still above its rising 5-day moving average, or it still has a rising 5-day moving average. We're kind of just right there. We have a large weekly implied move that we have yet to tag there. I will note we still see a series of higher lows, and price action is also kind of coiling up here. As you can see, the drip here is smaller than this drip, and this drip is here a little bit smaller. So price action here in Amazon is consolidating. And I want you to remember this because the next one I'm going to be showing you here is Tesla. And Tesla has already reached into its lower implied move for the week. You can see we exceeded it a little bit. We saw a snapback. We came back down into it. We doodled around, and now we're holding right above in these areas. So if Tesla, right, which I now have a long position, I reestablished a long position today, right at about these levels here towards the end of the live stream. If Tesla wants to start moving through, I would be paying attention. Obviously, we have the upper weekly implied move, but I would be looking at the 5-day moving average as a potential level to start turning back around and giving us a better trend. And then also the gap fill as potential levels of resistance. If I look at the aftermarket session, we're up a little bit here as we had some news that affected the markets, but we'll see what that looks like tomorrow. I can be right back down into these ranges and I'd be totally fine with it. My stop loss is at the low of today's trading session, which is at 374.29 right now. So the reason why I wanted to show you Amazon there and Tesla is because they're both contributors, they're both top holdings in the XLY. So if you do not want exposure just to these two names, or one specific name, but you want exposure to them, XLY would be a very good alternative here because it's about 40% or so, right around there, is the weighting that it has in the XLY. And then you get a little bit more diversification amongst other assets. So if I were to pull up the XLY, what did that do today? That came right into its lower implied move, right? And then we bounced from these levels and we're kind of holding up in these ranges. So if XLY wants to move, the 5-day moving average is kind of flattening out, but it definitely seems like with a strong Amazon and Tesla already reaching down to its lower implied move, it gives us an opportunity to potentially get some follow through in Amazon and maybe even some help from Tesla to come fill this gap and potentially go higher in XLY. So I'd be watching that one with a close eye. The next one I want to talk about here is Nvidia. And Nvidia, you can see as well as below its declining 5-day moving average. In fact, if we go to the daily time frame, this thing is below the year-to-date anchored volume weighted average price. It's been seeing massive volatility, right? I think it's even roughly around the 50-week moving average if you look at a weekly time frame. But if we zoom in on the 15, minute as it stands right now, we still have a wide open range, 109.66 and 130.48 as it stands currently right now. And this is coming after a pretty significant move to the downside in the last couple weeks of trading here. So overall, it did recover some of its move intraday, right? And it's holding that week to date. So if we can hold, because I did trade this intraday today myself as well, and I left some on for a swing trade, I can walk you through that trade more specifically. If you want to take a look here, we'll go to Nvidia and I'll show you exactly how I did it. So this was kind of happening in around the same time the S&P 500 was underneath its weekly implied move, but we were building a base here, right here on Nvidia in an early trading session. And then we broke out of that base. And I didn't enter on the breakout because it was already a strong move. But the first consolidation, as it pulled back to back test this area, is when I entered in. And then I kind of just held on to the shares. I ended up going to the gym. We just consolidated. We moved higher. We consolidated. We moved higher. And then while I was at the gym, the market started kind of pulling back. But nothing really substantial was broken. And then we had some follow through to that where I did remove a little bit over here on that move. And so I have a little bit left on for a swing trade for Nvidia. It's up in the aftermarket. We'll see what that looks like tomorrow and if we can get some follow through. If we do continue and just get a massive move, what you'll see me do is I'll probably be reducing once again, even further, or getting out of the position if it's a strong move at that 130.48, because that's the upper implied move there for Nvidia. Okay, so there's Nvidia. I can look at Meta, right? Meta, it's still above its weekly sorry, not weekly, I keep saying that. It's a 5-day moving average. We're seeing a series of kind of just higher lows throughout this chart. And it's been, every time it comes down to the 5-day moving average, it's kind of seen some pretty strong moves from those levels. So right now it's just consolidating sideways in this current context. And we have yet to tag one of those implied moves there, which we have 714.54 to the upside, 663.82 to the downside. So if you're bullish, I'd be saying pay attention to up here. If you're bearish, right, which I personally wouldn't be bearish because of the context of the chart, right? If you're just trading intraday, this is another one that I traded intraday from the short perspective today. I'm not going to walk through that one. I did so on my live stream. I kind of, it was right around here. But yeah, if you're a little bit more aggressive, then you can have opportunities on any time frame, both from a long or short perspective. Netflix is another one that's been really consolidating its earnings. And you can see here on the 15-minute time frame, we're above a 5-day moving average and we have a wide open range. So I'd be paying attention if you're bullish, that $1,000 marker or 949 below us. If you go to the daily time frame for Netflix, this was the earnings move. And really, we've just been consolidating within that candle in this tight formation. So if we do get some positive momentum, I would target right up to 1,000 and potentially even higher if we're going to just break out of this and see some continued action. Now, if we start moving down to the downside, pay attention to the quarter to date, which happens to be the year to date anchored volume weighted average price there too, which can act as a potential level of support. Okay, so there's some of the sectors. That is also some of the larger market cap names. I wanted to just really touch up on trend of the S&P 500. And to do so, I'm going to look at ES as this is kind of coming off a bit as I am recording. You can see we're just kind of saw this little gap up over here and we're kind of just coming in a little bit. But right now, if we go to the daily time frame over here, what we just saw here on the start of today's trading session, the start of the week, is we did hit a new low over here. So we had this series of lower highs and lower lows. Then we finally got our first higher high and higher low. And now, as you can see, we saw a rip higher, which did not create a new high. And we had this as a new low. So right now, it is now shifting its trend from being more positive over here to more of a consolidating period of time with a lower high and lower low. So how do I approach this? If I'm looking at this right out of the gate, I do definitely want to hold that year to date. So even if we pull in here, I feel like we have the potential to still move higher. But if we start breaking through this and we potentially opens the door for hitting a new low there in the ES. So that's what I noticed on ES. And then if you are bullish, right, it'd be nice to hold that level, consolidate, tighten up, and then break that prior swing high over there. If I look at NQ actually has a higher low. So you can see over here, we have a lower high, but yet that price action didn't create a new low. So S&P 500 is the one that got hit a bit. And we're still holding that year-to-date anchored volume weighted average prices. We're just slightly up on the trading year thus far. So just a lot of sideways chop right now as the market's kind of just been digesting. I want to hop really quickly into some of the intermarket assets. So I'll start off with gold over here because it just pulled up on my screen. We broke out to new highs today again, and it's kind of nearing its upper part of its range. So I just be cautious as this is consolidating, but a falling dollar definitely has helped this. Now, today, the dollar ripped significantly higher, coming into its upper band, and it reverted, putting in a topping tail. So is the dollar, right, it's still kind of holding this bullish trend. If the dollar continues higher, that could put pressure on various assets. And right now, it's kind of towards the middle, but the initial shock definitely put some pressure on the markets. Now, the 10-year yield came into its lower trend. The top of its band is coming in, and the lower band is kind of flattening out here as this price action is kind of just consolidating. So something that you might very well want to pay attention to is if we start breaking here, that could be an opportunity in various bonds and so forth, and it'd be potentially good for various intermarket stuff as well. If we take a look at crude oil, you can see it finished slightly down there on the trading session. We opened up right over here. We're still holding this trend. Now, if crude oil wants to catch a bid, all of a sudden move up, that could be giving us a sign potentially that the 10-year yield can follow suit. As you can see, there is a rather tight correlation between both the 10-year yield, right, and also crude oil as well. All right, that's all I got for you on today's episode, everybody. Like I said on the prior episode, we do have a pretty overly bullish 10-period moving average of the put to call ratio, and it still remains rather bullish in this case. So it's not quite the timing indicator, but it does help us, makes us aware that, hey, if we start to see the market pull off and start to cool off a bit, don't caught off guard by that, but allow yourself to be flexible. And if you're not flexible, right, and you still want to enter into a bunch of trades and so forth, one thing that you can do to pretty much immediately get better at trading is to cut your position sizing in half in times of higher volatility, and then widen your stops. If you just do those things, it's going to hold you in the trade longer and allow you some wiggle room. And when things tighten up, you can always add more to those spots. That's all I got for you on today's episode. Hope it helps out. I'll see you later.